Diversification is not about owning every asset class that you can think of and hoping that one goes up when another one goes down. We're really talking about efficient diversification. And diversification is directly connected to what's called correlation coefficients. In other words, how do the securities correlate versus each other? And I have two different securities over a 6-month period. I'm not going to give you the names yet, but if we look at the blue here, Brandon, and we compare that to the black, do you see any meaningful pattern there?
No, I don't think there's any real relationship between those two things.
No, and typically what portfolio managers will say is we want to own securities that move different from each other, that are not correlated. This would be an example of that, and I think they were both positive, and if we had 50% in each one of these, our line would have been a little flatter. So now we'll give you an example. That's a random correlation. Let's go to the next one. And this is an example of negative correlation. Same two securities, but as you can see, Brandon?
They are negatively correlated to one another. They have an inverse. When this security is going up, this security down here is going down, and when it skyrockets here, this goes down, and so on and so forth.
So a negative correlation is something that we don't really want in a bull market, because we can see this security was up about 6.5%, while this one was down 7.5%. So it's kind of like offsetting penalties. If I'd owned half of each of these, I'd been about zero, and really wouldn't have gotten anywhere for the 6-month period. Now, the next one is an example of
positive correlation.
Okay. Positive correlation has both of these securities moving in the same direction. And again, this is not something we necessarily want in our portfolio because they're both going down. So both of these had a drawdown or decline of about 18%. Now, we're going to tell you now what these two securities are.
Tom, this is the 20-year treasuries as highlighted by TLT and gold as highlighted by GLD.
Now, if we were looking at this as in the old way, in the way portfolio managers would look at it, so bonds and gold, those have to be negatively correlated, right? If interest rates go up, that's reflective of inflation. Bonds go down. Gold's supposed to go up with inflation. But we can see that those two securities had 3 different time frames where they traded totally different. And this is why the short term is so important. As Brandon said, an efficient portfolio is a moving target, and we wouldn't want to own either one of these securities, even though on paper it would look like that would be maybe a smart thing to do to reduce volatility.
And that's over the long run. Over the long run, they might appear to be inversely correlated to each other, but as we highlighted before, the short term is everything, and so we don't want to hold either one of these during this time frame. And that brings us to our next point of the benefit of diversification. And this is a way to, how do we comprise different securities in order to create an efficient portfolio for the given market? And I'll give you an example of how that's sort of calculated out. Let's say we have 3 different ETFs with a Canterbury Volatility Index or CVI reading of 75 apiece. So you have 3 ETFs at 75. Well, based on this, the average volatility of a holding within your portfolio would be 75. Now let's say that we combine these securities into the portfolio and just measure the volatility index of that portfolio, and it happened to have a CVI of 50.
Right, so you put a third, a third, a third in each, and say each one of these securities is moving different from each other. So the portfolio has volatility of 50, then our percent benefit of diversification would be 33%. Now we know that if volatility picks up, that's an indication that correlations
are getting higher.
They're getting higher. That's a bear market characteristic. So we want to monitor this percent benefit of diversification daily. And if that begins to drop, what we're going to see is that some of the securities in our portfolio are beginning to get more highly correlated. And if that happens, then you're going to be subject to what we don't want.
And that could be larger declines.
Larger declines.
Or spikes in volatility. So to give you an example of the benefit of diversification, up on the board here we have 2 exchange-traded funds, SPY and IVV. They both measure the S&P 500. And down below here, you can see our Canterbury Volatility Index. And as you can observe, both ETFs have the same volatility and the same movement of volatility. And since they're both measuring the same thing and are therefore perfectly correlated, if we were to hold a portfolio of 50% in each one of these ETFs, we would have a benefit of diversification equal to 0. So in other words, we would have no diversification and would be subject to whatever these ETFs decide to do. On the opposite end, if we were to hold SPY, which is the S&P 500 ETF, and SH, which is the inverse of the S&P 500, at 50% apiece, we would have a BOD equal to 100. And what that means is since these assets are perfectly negatively correlated, our portfolio would be a flat line, and you wouldn't see any movement within your portfolio.
So what we get from this is that sometimes our correlations can be too low or they can be too high. In the case of where we have two like securities, we're not benefiting by owning two. On the other hand, if we have them perfectly negatively correlated and we have 100% benefit of diversification, that's too high. So what we find is from our studies is that we want our portfolios to have a minimum percent benefit of diversification of around 25% or higher in a bullish market environment. If we're in a bearish environment, and again, that's an irrational period where no one really knows which way the securities are going to go, we just know they're going to move a lot, is we want somewhere in the neighborhood of about a minimum of a 40% benefit of diversification. That'll begin to stabilize the portfolio, limit our drawdowns to our normal bull market correction, and even though there's chaos maybe going on in the markets, our portfolio would be stable and you would never know that there's volatility outside in the individual markets.